Can you get approved for an auto loan with zero credit? Short answer is actually yes. Stay tuned, guys, and I'll give you some tips on how to increase your chances of getting approved with zero credit for a car loan. Stay tuned, guys. Guys, thank you so much for clicking on this video. Please remember to like this video and subscribe to my channel to stay up to date with all of my videos, guys. Let's get to today's video. Tips on getting approved with zero credit. Now, let's talk about zero credit score for just a second, because there's actually two different types of zero credit. Let's talk about the first type of zero credit scores. These are folks who have never had a loan, a credit card, an auto loan, collection bill, nothing in their name that has gone to their credit bureaus there. So that is a complete zero. Never had a loan or any collections or any type of credit card in their name as long as they have lived. So they're a complete zero. The other type of zero is actually folks who have had car loans or credit cards or collections in their name in the past, but because it has been more than about 7 years, their score has gone to zero. So if you have a credit card or an auto loan in the past there and you don't continue to use your credit, your score can actually go back to being a zero or basically just no credit because you don't use your credit. So that's two different types of zero credits there. These tips today will help for both there, guys. So let's dive into the first tip on how to get, or tips to get approved for folks with zero credit score. Now, full disclaimer here, everyone's situation is completely different. These tips are to help you increase your odds of getting approved for a car loan with no credit, but that does not mean that it is guaranteed to help you to get that car loan, guys. These tips, even if you follow them, you still may get disapproved, or you still may not be able to get approved, but these will help you get approved, and these will increase your chances a tremendous amount of getting approved here, guys. So let's start with the first tip here. So the first tip is going along with your income there. Steady income of more than $2,000. Now, if you make $2,000, you're right on the dot there, but $2,000 is the minimum. I say steady because you need to be on the same job for right around 6 months to about a year. That is really like the perfect time to try to get an auto loan with zero credit. And the reason I say that, you can still get approved for an auto loan with 2 months on the job, 1 month on the job. But when banks are looking at your file, they can't look at your credits to see how you've done in the past there to kind of base their approval on that. So what they're looking at now is they're looking on different factors, and one is on your income. So if you've got a steady income and they can see that on your income or your pay stubs that you're making a good steady income and you've been there for a little while, that will increase your chances of getting approved for an auto loan with zero credit. Now, I did say pay stubs. This income has to be provable. And what I mean by that is the income has to be provable with an official pay stub. If you get paid on the side or what's called under the table there, that income is not provable. And I get that you may make $2,000 a month doing whatever you're doing that is under the table or is not tracked with an official pay stub, but it is very important that you have an official pay stub from your company, because that's what the bank's going to look at there, guys. They're going to look at your year-to-date gross income on your pay stub there. Let's talk about gross income, right? So $2,000 a month is your gross income. There's also something called net income. And what net income is your gross income minus all of your deductions. So your taxes, the FICO tax fee there, health insurance, any things that come out of your check. After all of those charges and deductions come off of your check, that is then called your net pay, or your take-home pay, what a lot of people call it as take-home money there. So gross is your money before taxes, before your health insurance, before any deductions come out of your pay stub. $2,000 in gross income is really where you need to be having your income minimum. If you have more than that, fantastic. But $2,000 is really the minimum for the income there, guys. Let's move on to tip number 2. Tip number 2. Proof of residence. And what I mean by proof of residence, you have to have 2 proofs of these residence. So let me give you some of the things that can prove your residence. And these documents have to say your name, your street address that you are currently living at. So for me, Troy Paul, and it should say 123 ABC Avenue, blankety, blankety, blank, right? So the proof of residence should have your name on it and your official address that you are currently living at there, guys. So the forms that you can use is utility bills, phone bills. You can also sometimes use bank statements. And you can periodically use insurance bills, so your auto insurance bills. So I'm going to leave it there. So let's talk about utility bills. So utility bills are your electric, your water, your sewer, your heating bills. That is your utility bills there, guys. And as long as it has your name and your address on it, that counts as one of the documents. Now, you can get 2 of these forms. So if you have your heating and your electric bill, well, that's 2 documents right there. And check those 2 boxes off. But it's really important to get 2 of these proof of residence. The next one is phone bill. So if you have Sprint, T-Mobile, AT&T, Verizon, whatever your phone bill is, you can bring 1 copy of that bill stating your name and your address right below it. Bank statements. With your bank statements, your whole bank statement there will say your name and your address on it as well. And some banks will use your bank statement. It has to be the most current bank statement. And all of these have to be the most current utility bills, phone bills, within the last 15 to 30 days. So the most current statements that have come out for all of these is the most important there. And then last, some banks will take insurance bills. Now, these 2 right down here at the bottom, this is really bank to bank there, guys. Some banks won't accept bank statements, and they also won't accept insurance bills. So it's really, if I was you, and this was what I was doing, I would try to find 2 utility bills. That I would take care of right there. So if I can get my heating and my electric bill, or my water bill and my electric bill, or whatever array that you have, 2 of the utility bills would be the easiest way. But if you can't, the next best is really the phone bill. And if you don't have either one of those 2, do the bank statement and the insurance bill for your auto insurance, and then see if that will really work there for you guys. So that is the second tip that you really need to kind of collect before you go to get an auto loan. Proof of residence really needs to be 2 forms of proof of residence, and it really will help you to make this transition a little bit smoother into getting you into an auto loan. So it's tip number 2, proof of residence with your name and your official address listed right at the top there. Let's move on to tip number 3. Tip number 3. This is very important for you and for the bank. Save up 10 to 20% DP, as in down payment. So DP stands for down payment. Save up 10 to 20%. Now, if you're looking at a $10,000 car, 10% of that car is $1,000. 20% is $2,000. That 10% is really, really the minimum. And let me explain why. This is beneficial to you, first of all. So when you put down payment down, it's going to save you money in the long run, especially with having 0 credit. Your interest rate, once you get approved, your interest rate is going to be higher and elevated compared to a prime loan. So the more money you put down, the less you're going to pay in interest in the long run. So that's the reason why it's really beneficial to you. It also lowers your payments. So the more money you put down, the lower your monthly payment is. That saves you a little bit of money every single month. Second thing is, down payment is very, very pivotal to the banks. And the reason that it's pivotal to the banks there is because they're looking at the equity of the car. And what I mean by equity, if your car is worth $10,000 and you're putting down $1,000, that car is then going to be financing $9,000 plus your taxes and your tags for your state and your wherever you live. But $9,000 would then be the value or the amount that you're financing, but the car is still worth $10,000. So you would have $1,000 in positive equity because you're putting down $1,000 there, guys. So the bank looks at it. The bank also is going to look at your down payment as a commitment from you to this car to making your payments. Because if you can save up $1,000 down, they would hope that you can make a $250, $300 payment there, So down payment is very, 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 very important. It saves you money in the long run. It saves you monthly payments every single month. It makes that payment go down. And it also looks better to the bank and also gets you a little bit better of an equity position there, guys. Let's move on from step number 3. But before I do that, let me give you the equation here. So X stands for the price of the car. So if you're looking at a $15,000 car, you'll put 15 where X is. You're going to times 15,000 times 10 or 20%, anywhere is in between there, and that's how you're going to get your equation. So if the car is $15,000, 10% of $15,000 is $1,500. That's what your down payment would be on a $15,000 car, and you guys can do the math for yourself. I did the math down here. $10,000, 10% is $1,000. Pretty simple math there, guys. Put it in your calculator, you'll figure it out, but save between 10 and 20% to put down on that vehicle. Let's move on to step number 4. Tip number 4, let's talk about how much you can afford monthly payment-wise. So let's talk about PTI, payment to income. So that is what the bank is looking at when they look at your whole deal here, the whole situation that you're in. They're going to look at what the car payment is to your income. So PTI, payment to income. Remember that word, payment to income, or phrase there. So let's do the math here, and I'll show you kind of what the banks are looking at. So the max PTI that the bank will allow you to have is right around 10 to 15% in the best case scenario. 10 to 15% best case scenario. So what the bank will is, this is literally the same equation for the down payment, but basically backwards there, guys. So if you make $2,000 a month, 10% PTI, or payment to income, you could afford a $200 payment if that's what they're basing it on. Now, if it's a nicer bank, they will sometimes give you up to about 12.5%, which would make you a $250 payment. And then if it's a really, really good bank, they'll give you a 15%, and that'll give you about a $300 a month payment there. 15% payment to income is very unique with a zero credit score. 15% is usually with prime deals. They'll give folks with great credit about 15%. So we're going to take the 15% out of the equation for this situation. We're going to focus right on about the 12.5% for $250 a month there. So $250 a month is what you can afford in that range if you make $2,000 a month according to the payment to income calculator here. So this is very important because tip number 5, I'll teach you how to figure out what a $250 payment is going to get you car-wise there. But very important to kind of stick around this though, because this is the payment that the bank's really going to allow you to have on a certain vehicle there. So payment to income is very important. Now, if you make more money, let's say you make $3,000 a month, and the bank is giving you 10%, well, that's a $300 payment right there. And again, so on and so on. You literally take your monthly income, your gross monthly income, like we talked about earlier in the video, before your deductions and before your taxes come out, gross monthly income, and times it by 10 to 12.5%. And that is what you're going to be able to afford monthly payment wise, guys. So let's move on. I'm going to take you to tip number 5, and this is going to teach you how to take your payment to income and put it to a car loan, guys. I'll be right back with tip number 5. All right, guys, tip number 5, and this is going to be how much car can you afford? And this is literally taking the max payment that you can afford with your gross monthly income and putting it to a car. So let's use the example that you make $2,000 a month times the 12.5% that we're going to use payment to income. The bank is approved for 12.5% payment to income. That will leave you with a $250 a month payment, like we were talking about in tip number 4. Now, a $250 payment at 22% interest rate, which when we have zero credit, if you were able to get approved, the interest rate is going to be very, very high. Now, I'm using 22% as an example. It may be lower than 22%. It may be 20%. It might be 18, 16, 15, 14. I don't know. I'm just using 22% as a baseline because it's better to kind of have a higher interest rate and look at a more affordable car, and then you get there and then the payment's actually lower. That's better than you looking at a expensive car that is, if you base it on a 14% interest rate and you look at a $20,000 car when you can only afford a little bit less than that there, guys. So it's very important to kind of over-guess on this interest rate here than under-guess, because it's always better to have a cheaper payment than a too high of a payment, and then you don't get approved. So $250 at 22% interest, you're looking at a $10,000 car there. Now again, if the interest rate is lower and you still can stick at the $250 payment, this will go up. But that is kind of where I really would kind of stay around. Looking at, in this situation, a $250 a month payment, you're looking at a $10,000 car there. Which you can find decent cars for $10,000, especially for your first auto loan, guys. Just make sure when you go and you look at these cars online to take a good look at $10,000 cars, because some are bad and some are great. You just got to do some research there, guys, in your area where you live. Now, I did some other math here. So if you can afford a $300 payment, let's say that you make $3,000 a month and they're giving you 10% of your monthly income there, then you can afford a $300 payment, 22% interest. You're looking at a $12,000 car, guys. And so on and so on. Look, guys, you can go online on an auto calculator on Google and type in these numbers there of what the payment's going to be on an X car, right? So that's literally what I did. I have a calculator here that we use when we're doing calculations for payments. That's what I literally did, was just do backwards. $12,000 gives me a $300 a month payment. And these payments are based on 72 months, guys. Now, so that's what you're looking at. So these are $10,000 financing cars, amount to be financed, $10,000 and $12,000 amount to be financed over 72-month terms. And these are the kind of payments that you're looking at here, guys. Do your own math. Look for cars that fit your budget, because everybody's situation, again, is so unique. Look at your budget, what you can afford, and figure out cars that are in your budget there. This is just giving you a rough guesstimation. This is hopefully to help you guys out and get you a little bit better of an opportunity to get approved with zero credit, guys. Let me give you tip number 6, guys. I'll be right back. Tip number 6. Be realistic. Tip number 6 is be realistic. Realistic there, guys. This is very important, because I see a lot of times folks will come into the dealership here who have never had a car loan or have had car loans and they're still back at a zero credit score, or they might have rough, bad credits that they're looking at $30,000 trucks and they want to be at $300 a month there, guys. So this math is to help you. This is to help you go into the dealership and be as knowledgeable as you possibly can when you go into the dealership to purchase your next car with a zero credit score. So when you go in there, please be realistic. When you look online, be realistic there, guys. Once you did the math on yours, you see that you can afford a $15,000 car based on your monthly income and the payment, be realistic. Those payments that we talked about earlier, that is, again, a case-by-case situation. You might look at your income and say, I can't afford a $300 a month payment. I can only afford a $250 a month payment. And then you go back to looking at a little bit more affordable car there, guys. But the last thing you want to do is waste your time going to a dealership or anywheres to look at $25,000 cars when you can afford a $15,000 car a month payment there, guys. Just be realistic. When you're going into the dealership, we're here to try to help you, but be knowledgeable as well. It's kind of a catch-22, guys. When you're looking online and you see that you can afford a $15,000 car, just don't go looking for a $35,000, $40,000 truck, SUV, boat, anything. Stick around your budget there, guys, because it's going to help you out and it's going to increase your odds to get approved with zero credit. The last thing you want to do is go into the dealership, sit there for 2 hours, and then them not be able to get you approved because you're on too much car. Be realistic. Find a car online that fits your needs, fits your budgets, and that you like, and then pursue that car there, guys. Don't go around and let everybody shop your credit and figure out a way to get you approved on a random cars. find the car that you want, pursue that car, and then get that car there, guys. Be realistic. Step number 7. Let's go to that. The tip number 7. I'll be right back. Tip number 7, and this is our last tip. So tip number 7, this is after you have already gotten approved, you found the car that you want, you can afford the car that you want. Step number 7 is very, very, very important. Gap insurance. Now you might say, I have no idea what gap insurance is. Gap insurance is very, very important. Let me show you here on a scale what gap insurance is. So you've gotten approved for the car, everything is cool. You obviously have probably noticed that the interest rate is going to be high, right? So when you purchase the car and you put your money down, the car loan is going to be up here, the equity is going to be up here, all the numbers are going to be up here. So let's use it in a plain example. You're financing $12,000. The car is worth $12,000 when you finance a car. So you're at 100% equity in the car there. After tax and tax, you equal out to being 100% equity. Now, as everyone knows, cars drop as soon as you purchase them, right? There's always the running joke, once you purchase a car, it drops in value as soon as you leave the lot. Get it? I've heard it a million times. But it is very important to know because the car loan will not drop as quick. So top line is your car loan, bottom line is your car's value. You can see it steadily goes down, right? The car loan or the car steadily goes down. The car loan will not go down as quick, and the reason being is because you have to pay interest. Now, if you had a 0% interest loan, then that would be different because you would be paying completely to the principal of the loan. But with interest, you are paying interest, and especially with zero credit, the interest rate's going to be high. So you're going to be paying interest probably for that first year to about a year and a half there, guys. Gap insurance, if you wreck your car in between here, you are going to have what's called negative equity. Let me explain what I mean by that. Let's say you wreck your car right here and right here, all right? Let's say you wreck your car right in between that line there, right? So same timeline, years here on the bottom, value and price up here on the top there, guys, right? So let's say you wreck your car right in this area here, all right? Your loan, let's use a plain example. Let's say your loan is still $10,000. You still owe $10,000 on the car, but your car is only worth $8,000. You all of a sudden have a deficit of $2,000 because your car was totaled. It could have been your fault, it could have been somebody else's fault, it could have been a tree that fell down and destroyed your car. But all of a sudden, now you found yourself in a $2,000 negative equity position. It is incredibly important to get gap insurance because if you have gap insurance, gap will continue to cover literally the gap right there. That gap right there will be covered. So this $2,000, if you get gap insurance, it will be wiped out because gap insurance will pay that $2,000 difference there, guys. So incredibly important tip here. Once you get approved, once you've agreed to the payment, once you figure out the exact car that you want, and everything's worked out, once you go into the F&I box for the office there and you talk to the F&I manager or the business manager, please be sure to ask about gap insurance. It is very, very important there. You can also ask your insurance company about gap insurance, but I will do a video on the difference between dealership and gap insurance, dealership and insurance company gap insurance is there. But it is important, no matter where you get it, get yourself gap insurance. It is very, very, very important, especially in this situation there, guys. I also have a bonus tip because we were talking about insurance company. Bonus tip here at the top. Before you sign the papers and you purchase the car, get yourself an insurance quote. It's important for an insurance quote on the vehicle there before you purchase the car because let's say you sign up for a $250 payment and then you take the car home and you realize, oh no, it's going to be another $200 for insurance. Make sure that you can afford the payment and the insurance. It is very, very important because without insurance, you really can't drive your car. You really shouldn't drive your car. It is very, very important to understand that you have a car payment and you're going to have to pay insurance on this vehicle. Be sure that you can afford the insurance on it and the payment. With zero credit, you're starting fresh and clean. This is an opportunity for you to build your future credit. This is an opportunity for you to continue to escalate your credit so that in 2-3 years when you want to buy another car, you can come back fully knowledgeable and fully ready to get a better interest rate. Guys, thank you so much for watching this video. Please remember to like this video and subscribe to my channel. It helps me out so much there, guys. If you have any questions, I'm always here to help as much as I possibly can. Just put a comment down in the comment section below, or you can email me at paul.phillip7@me.com. I'm always here to help you. This is a video to really help you get yourself an auto loan with zero credit. Again, this has been 7 tips to getting approved with zero credit. Thank you guys so much for watching. I'll see you in the next video.